Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending February 24, 2023. Looking at the market indexes for the week, the TSX, S&P 500, Dow Jones, Russell 2000, and NASDAQ were all down on interest rate hike worries in the US and recession worries on both sides of the border. Gold was down a third week in a row. Oil was the only thing up this week and only a little. Looking at Canada first, on Tuesday we had Canadian inflation numbers for January. Core and headline inflation year over year was lower than forecast and than the previous month, but the macro events of global inflation and political tensions affected the market on Tuesday, and it went down after what was essentially very good news. Perhaps the Canadian Central Bank promising to hold made these numbers less important. Also, the month over month numbers weren't quite as rosy. So, looking at the core CPI year over year for January, the actual was 5%, which is heading down towards the 2% that is the target rate. And this was lower than the 5.5% forecast and lower than the previous month's 5.4% year over year. The month over month core CPI was higher than forecast and also higher than the previous months. Turning to the headline CPI, which includes the volatile groceries and energy, the year over year was 5.9%, which was lower than the 6.1% forecast and lower than the 6.3% the previous month. But the month over month CPI was 0.5%, lower than forecast, but much higher than the previous month's negative 0.6%. In a related story, Canadians' debt is now at 1.83 times their disposable income as of Q3 of last year. The debt keeps constantly rising. There were expectations of the Bank of Canada cutting rates in the second half of 2023 and helping with the debt's interest, but that doesn't look likely now, as the bank said that they will not touch rates until 2024. Note that Canadians are more heavily indebted than Americans. We didn't deleverage in 2008. That and the fact that our real estate is more involved in our economy and a larger part of our net worth than in the US is another reason why the Canadian Central Bank is pausing rate hikes while the US Fed keeps raising. The Canadian Central Bank isn't responsible for our government or Canadians being able to pay our loans and mortgages, but the bank is aware that it needs to be careful with its rate hikes because they could have significant impact on the economy if people start defaulting on their mortgages, causing more economic damage than expected. A boom in immigration into Canada and non-permanent residents has caused rental markets to struggle to accommodate housing demand. This is causing a disconnect as policy pushes for population growth through immigration in Canada without coordinating with the housing sector. House prices have not come down as significantly as the carrying costs have come up due to the higher interest rates. Arguably, housing affordability is lower now than before COVID, which has made people stop looking to buy. Instead, they stay renting or start renting, driving up rental prices by 20% from a year before, which causes investors to not put their properties on the market or buy rental properties instead, driving prices up further. A guest on BNN showed some interesting statistics about Canadian dividend payers on the TSX and their total return. Dividend paying equities have far higher returns than non dividend paying Canadian stocks. The Canadian dividend paying equities have even managed to outpace the TSX return average, which of course includes dividend and non dividend payers. Over the past 30 years, dividends have added 30 to 40% of the TSX total return. Turning to the US, on Friday, the US PCE, Personal Consumption Expenditures Index, came in higher than expected. This is the metric the US Central Bank uses, and since inflation was higher than previous month's reading and higher than expected in all categories, this was bad news. This has led to expectations of higher interest rates from the US Fed, and the market sold off on Friday. The US dollar strengthened because of the higher interest rate expectations. The US core PCE index month over month was up 0.6%, higher than the 0.4% forecast and previous month. The year over year for January was up 4.7%, again higher than forecast and than the previous month. The main US price index for month over month was up 0.6%, higher than forecast and higher than the 0.2% the previous month. And the headline year over year for January was up 5.4%, higher than the 5% forecast and still higher than the previous month. On Tuesday, the US manufacturing PMI, price index for manufacturers for February, came out, and it was higher than expected and higher than the previous month. The stock market, especially in the US, saw this as further inflation and further rate hikes and once again sold off. And on Wednesday, the US Fed minutes from their previous meeting came out, and there was information about further rate hikes. In fact, multiple rate hikes, but only 0.25% rate hikes. And the US market was mostly flat with not much changing as a result of the minutes. The 2% inflation target was confirmed. The market had to deal with a confirmation of, quote, higher for longer on the interest rate front. Another 2 or 3 interest rate hikes of 0.25% or perhaps 0.5% each are expected by the market in the US going into June, adding up to 0.5% to 0.75% from where we are today. This will strengthen the US dollar. Credit card debt is hitting a record high 986 billion in the US as inflation weighs on consumers. Credit card balances are above the pre-COVID levels, but the consumers are able to service that debt better than before COVID because their salaries have come up as well. Shares of the chipmaker Nvidia jumped on Wednesday after the company reported better than expected quarterly results. Nvidia had already been riding high as investors see it as a well-positioned stock to weather an economic downturn and decline in PC sales. The stock was already up more than 40% this year going into Wednesday's evening's earnings announcement. Nvidia is also in a good spot when it comes to blossoming artificial intelligence demand. Its data center segment, which includes AI chips, showed continued growth in the most recent period. Walmart and Home Depot kicked off retail earnings season with a whimper. Walmart, the nation's biggest retailer and grocer, offered a lighter forecast than expected for the year, as it expects inflation-wary consumers to continue to avoid discretionary purchases like electronics and focus more on essentials like groceries. Home Depot, meanwhile, reported revenue that missed estimates for the first time since November 2019. The home improvement giant also said it's seeing customers shopping more cautiously. Quote, "We've seen an increasing degree of price sensitivity as the year's gone on, which is actually sort of what we predicted in the face of persistent inflation," end quote, said Home Depot's CFO. Turning to some bits and pieces, Chinese equities fell for a third consecutive week last week. Despite a modest rebound so far this week, the MSCI China Index is down 8.4% from its 2023 peak in late January. But I believe that the setback should be seen as a healthy consolidation after a 3-month rally. I maintain a positive view on China's economic outlook and believe the internal political and regulatory situation has softened. I remain positive on emerging market equities globally, including Chinese equities. Note, however, that the days of China being the world's factory and using China's cheap manufacturing and exporting all over the world are over, and China is no longer viable for that purpose. This is due to the political situation, regulatory issues in the past, and ambitions on Taiwan in the future, just in case inventory approach, and the shutdown they had during COVID. Turning to energy, renewables are set to dominate growth in global electricity supply through 2025. Growth in global demand for electricity is set to accelerate over the next 3 years, with low emission sources led by renewables expected to cover almost all of it, according to the IEA, which is the International Energy Agency, latest electricity market report. Emerging and developing economies in Asia are driving forces behind the faster pace of electricity demand growth, according to the report, with more than 70% of the increase between now and 2025 coming from China, India, and Southeast Asia. Last year, amid the turmoil of the global energy crisis and exceptional weather conditions in some regions, the world's electricity consumption showed its resilience as growth slowed only slightly to 2%. The strong growth of renewable means their share of the global power generation mix is forecast to rise from 29% in 2022 to 35% in 2025, with the shares of coal and gas-fired generation falling. These trends mean that although the carbon dioxide (CO2) intensity of global power generation will continue to decrease through 2025, the power sector's annual CO2 emissions are set to remain around the levels of the record high they reached last year. Global oil demand growth will shift up a gear as China reopens. The world oil demand growth is picking up after a market slowdown in the second half of 2022, with China set to account for nearly half of the increase in global demand this year, IEA's latest monthly oil market report finds. Countries outside of the OPEC Plus group are stepping in to support global output. Nearly a year on from Russia's invasion of Ukraine, oil markets are trading in relative calm. Oil prices are back to pre-war levels, with the exception of diesel, though even this has drifted much lower from last summer's historical highs. World oil supply looks set to exceed demand through the first half of 2023, but the balance could quickly shift to deficit as demand recovers and some Russian output is shut in. Fossil fuel consumption government subsidies worldwide soared in 2022, rising above 1 trillion for the first time, according to IEA's latest estimates, as turmoil in energy markets sent fuel prices in international markets well above what was actually paid by many consumers. Prices for fossil fuels were extraordinarily high and volatile in 2022 as energy markets grappled with the strains caused by Russia's invasion of Ukraine, in particular the sharp cuts in Russian natural gas deliveries to Europe. In many countries, though, the prices actually paid by consumers for these fuels remained at a much lower level due to a range of policy measures to insulate consumers. Last year's record subsidies, amid the global energy crisis triggered by Russia's invasion of Ukraine, were double their 2021 levels, which were already almost 5 times those seen in 2020. These escalating outlays were in sharp contrast with the Glasgow Climate Pact, which was agreed at the COP26 Climate Change Conference in November 2021, and called on countries to, quote, phase out inefficient fossil fuel subsidies while providing targeted support to the poorest and most vulnerable. And finally, next week, we have ongoing Q4 reporting. On Monday, we have Element Fleet Management, MEG Energy. On Tuesday, we have Bank of Montreal, Bank of Nova Scotia, Laurentian Bank. On Wednesday, we have Royal Bank, Lowe's, National Bank, Tricon Capital, and New Flyer, a small bus company in Canada. On Thursday, we have Toronto Dominion, Canadian Natural Resources, Costco, Canadian Utilities, Parkland Fuel, Crescent Point, Canadian Western Bank, and finally on Friday, we have SNC-Lavalin. Economic events next week. On Monday, we have US pending home sales. On Tuesday, we have the Canadian GDP to see if we are nearing a recession in Canada. On Wednesday, we have US and Canadian manufacturing price index for an inflation read. And on Thursday, we have the important US initial jobless claims. That concludes my thoughts for the week. If you have any requests on what you'd like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.